Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today, we're looking at NVIDIA.
If you find our talks useful, please consider subscribe, like, and comment underneath.
And before we get into today's stock, here is a useful tool for investors who want a faster and cleaner research workflow. You can check out stockanalysis.com Pro through the link below in the description. Use discount code ITP for 10% off. Stockanalysis.com is lightweight, fast, and works on desktop, iOS, and Android. The free version is useful for checking stock prices, financials, charts, forecasts, and news. But if you want deeper research, stockanalysis.com Pro gives you no ads, saved screeners, watch lists, portfolios, long-term financial history, dividend history, analyst filters, ETF data, and exports to Excel, CSV, and Google Sheets. Pro comes down to about $5.93 per month when billed annually after the discount. For heavier users, the unlimited plan adds unlimited downloads and unlimited stocks per watch list, and comes down to about $14.93 per month when billed annually after the discount. Stockanalysis.com is a research tool, not financial advice. It does not tell you what to buy or sell, and it does not guarantee investment results. Always do your own research and make your own investment decisions.
This is an affiliate link, so we may earn a commission if you use it at no extra cost to you.
Okay, so let's just cut right to the tension at the center of the market right now, because, we are looking at a company that is basically architecting the entire global artificial intelligence industrial revolution.
Yeah, the top line numbers are just, they're staggering.
They really are.
I mean, we are talking about Q1 fiscal year 2027 revenue hitting $81.61 billion.
Wow.
Right?
Yeah.
That is an 85% year-over-year surge. And net income climbed 211%.
Which is just astronomical for a company of this size. But here is the critical hook for your portfolio. Because despite these hyper-growth numbers, despite all of that, the stock just experienced a really violent 5.9% intraday drop.
Yeah, on June 6th.
Right, June 6, 2026. And that drop is exactly why we're doing this analysis today.
Okay.
Our mission here is to figure out if that 5.9% hit was just, a temporary macro-driven panic, or if it's the first actual crack in the armor of this market titan. Because the market just proved that no matter how big a company is, nobody is immune to volatility.
Absolutely nobody.
All right, let's move into the wealth building context.
So to really evaluate this for a multi-year investment horizon, you have to look past the panic of a single trading day, right? You need to examine the actual mechanics of their economic moat.
Right, and people always use that analogy, that they're building the railroads for the AI boom.
Yeah, I hear that constantly.
I actually think that's a really tired, overly simplistic way to look at it, because railroads are commodities. I think it's much more accurate to compare them to Apple's App Store, but for massive industrial scale compute power.
Oh, I totally agree. That is a much better way to frame it because it really highlights the software lock-in. Everyone gets so fixated on the physical silicon, right? The GPUs. But the silicon is really just the entry point to a full stack moat. The real trap for competitors is that software layer, CUD.
Right, CUDA.
Yeah. If you're a developer writing an artificial intelligence model today, you are almost certainly writing it in CUDA. It's just the programming language they've all learned. It's what they optimize for.
And you can't just take that complex code and effortlessly run it on some cheaper competitor's chip, right?
No, not at all. The switching costs are absolutely astronomical.
And let's explain the hardware networking side of that moat too, because I think people miss that.
Yeah, go ahead.
So when a major tech company, what we call a hyperscaler, so like an Amazon or Google, when they buy 100,000 GPUs, the primary bottleneck is actually how fast those individual chips can talk to each other. If they can't share data instantly, those billion-dollar chips just sit there idle, wasting power. And that's where InfiniBand comes in.
Right, InfiniBand.
It's essentially this high-speed nervous system connecting all the chips. So by controlling the chips and the CUDA software and the InfiniBand networking, they control the entire operational environment.
Which completely explains why they currently dominate a staggering 80 to 86% of the AI accelerator market.
86%. It's wild.
It's a monopoly, essentially. And they're actively deepening that ecosystem right now with something called NVIDIA Inference Microservices.
Okay, break that down for the listener.
So by selling these prepackaged software microservices, they're transitioning from just selling hardware to actually pulling in recurring software revenue.
Oh, wow.
Yeah, they're making their infrastructure the absolute inescapable industry standard.
But as an analytical investor, you have to ask a really hard question here.
Which is,
Well, when the entire market already knows they own the ecosystem, when it's this obvious, is the price of admission already too high? Like, does the current valuation leave any room for error, or are you buying at the absolute peak of the hype cycle? Well, that's the trillion-dollar question.
Now let's look at the fundamentals.
Because if you want to know if the hype is actually justified, you have to look under the hood at the actual cash being generated.
And the fundamental cash engines here are historic. I mean, just looking at the data center segment alone, it contributed $75.2 billion.
Just that one segment.
Right, up 92% year over year. For context, their full-year fiscal 2026 revenue landed at $215.9 billion.
But what you really need to pay attention to is the efficiency of that revenue.
yes.
They reported a 75.2% gross margin and a 63% net profit margin.
Let's pause and explain what that actually means, because that is arguably the most critical metric for your risk assessment.
Absolutely.
A 63% net profit margin means that for every single dollar that comes in the door, 63 cents drops straight to the bottom line as pure profit.
Which is insane. Right. Those are software margins. Hardware companies are not supposed to have margins like that. Historically, hardware gets commoditized and margins compress.
Sure, usually.
So my immediate pushback is, how on earth can they maintain a 75% gross margin when massive competitors with unlimited budgets are actively spinning up their own custom silicon?
Well, they maintain it because right now there is simply no viable substitute at scale that matches their total cost of ownership.
Okay, total cost of ownership.
Right. Because the hyperscalers care about the time it takes to train a model and the energy required to run it.
A power draw is huge.
Exactly. So that full stack integration we just talked about, it still makes them the cheapest option when you factor in
Right.
power consumption and deployment speed.
Yeah, that makes sense.
And just look at the guidance for Q2. They're forecasting $91 billion.
$91 billion in a single quarter.
Yeah. And what makes that figure so structurally bullish is that management explicitly stated it completely excludes the Chinese data center market.
See, that is a massive flex.
It really is.
They are essentially saying, we can hit historic revenue numbers with one hand tied behind our back.
Yep.
And they're using this hyper-growth phase to aggressively fortify the balance sheet. I mean, they ended fiscal 2026 with over $60 billion in cash and equivalents.
Wow.
And they generated $96.58 billion in free cash flow. They are drowning in so much cash that they just raised the dividend to 25 cents and authorized an $80 billion share buyback program.
Which, by the way, completely changes the valuation math for anyone worried about the price.
How so?
Well, you might see the stock trading at a forward PE of 26x and think, that looks a bit expensive. But remember how forward PE works. It's the stock price divided by expected future earnings.
Right.
The earnings part of that equation is expanding rapidly. And thanks to that $80 billion buyback, the number of outstanding shares is shrinking.
Oh, right. So they're retiring shares.
Exactly. So a 26x multiple is actually quite reasonable when the underlying business is growing this efficiently.
That brings us to the catalyst timeline.
Because even with a reasonable multiple, you need to know what specific events are going to drive the next phase of revenue, right? And test the market's conviction.
Yeah. You can't just buy and hope.
The biggest and most obvious fundamental catalyst is that Q2 fiscal 2027 earnings report coming in late August. Given the conservative China-excluded guidance, there is a highly plausible setup for a massive beat and raise.
But, before we get to late August, you have to navigate an immediate severe headline risk.
The Senate hearing.
Right. On June 11th, 2026, CEO Jensen Huang is scheduled to testify before the Senate Banking Committee regarding China export controls.
Yeah, that's a big one.
We just saw what the anticipation of macro pressures did to the stock on June 6th. For anyone holding this, that Senate hearing is going to induce serious volatility.
It will absolutely create noise, there's no denying that. But you can also look at it as a necessary clearing event.
A clearing event?
Yeah, because markets hate uncertainty way more than they hate bad news. If the Senate hearing establishes clear regulatory boundaries, the uncertainty is removed, and then institutional money can model the risk accurately.
That's a fair point.
Meanwhile, the underlying demand narrative is about to get a massive boost from the upcoming Anthropic and OpenAI IPOs later this year.
Okay, let me stop you there. Because Anthropic and OpenAI, they're pure software companies.
Yeah.
Why should someone investing in a hardware infrastructure stock care about a software IPO?
You should care because of the S-1 filings.
Oh, the financial.
Exactly. When these private AI companies go public, they are legally required to open their books to the world. So for the first time, Wall Street is going to see the raw, unfiltered data on exactly how many billions of dollars these software companies are forced to spend on compute power just to survive.
Ah, so it's proof.
Yes. It will be the ultimate, highly publicized validation of the revenue trajectory we've been talking about.
That makes a lot of sense. It proves the demand isn't just, theoretical hype.
Right.
And speaking of expanding demand, you also have to factor in the product launches. So the Vera Rubin platform is entering its full production ramp, which basically keeps them ahead of the data center competition.
Yeah, Vera Rubin is huge.
But the real curveball, the one I think people are sleeping on, is RTX Spark for the PC market.
Oh, this is such a critical pivot.
It is. They are taking their absolute dominance in the data center, and they're using it to invade the personal computing space.
Which is largely untapped for this specific kind of architecture.
Right. The PC market is a massive, high-margin, total addressable market that has historically been dominated by a traditional x86 architecture company.
Like Intel and AMD.
Exactly. By pushing RTX Spark into consumer and enterprise PCs, they're just opening up an entirely new revenue frontier.
Now let's pivot to the chart.
Because we need to see how the tension between these massive fundamental growth catalysts and those geopolitical fears is actually manifesting in the price action.
So currently, the stock is trading around $206.12.
Okay.
That represents a 12.6% pullback from the 52-week high of $235.74, which was established back in May 2026.
And if you want to understand the market psychology right now, you have to look at the volume behind that recent 5.9% drop on June 6th.
The volume was crazy.
It happened on over 150 million shares traded.
Wow.
Yeah, and when you see a sudden, violent drop on volume that heavy, it tells you exactly what is happening. Macro fears just completely rattled the short-term traders.
It was a washout.
Exactly, a classic capitulation event. It flushed out the weak hands and the momentum traders who basically panicked over the upcoming Senate hearing.
But you can't just look at the red days.
Right.
Look at the structure right before the drop.
What do you mean?
Well, on June 2nd, immediately following the Computex keynote where they confirmed the Vera Rubin production timeline, the stock surged 6.3%. And that was also on massive volume.
Oh, interesting.
Yeah, so that tells a totally different story. That is absolute proof of strong institutional accumulation. The smart money was actively buying the fundamental catalysts.
From a purely technical perspective, the chart is doing exactly what it's supposed to do.
Yeah, it's pretty textbook.
The stock is currently retesting the $212 support level. For anyone unfamiliar with chart mechanics, $212 was the previous major high back in October 2025.
Right.
So this is a classic break and retest pattern. It broke out above the old ceiling, and now it's pulling back to see if that old ceiling has solidified into a new floor. So the long-term trend is still definitively intact.
Yeah, the momentum is undeniably upward. I mean, the stock is up 9.3% year to date, and it's holding above all the major moving averages.
And what are the technical analysts targeting?
They have clear targets mapped out at $236, $250, and eventually that big psychological $300 level.
So what does market sentiment look like?
Well, we have to connect that institutional accumulation we're seeing on the chart to what Wall Street analysts are actually modeling behind closed doors.
And it's pretty bullish, right?
Oh, but the quantitative sentiment is overwhelmingly bullish. Out of 53 analysts covering the stock, 51 rated a buy or strong buy, with a consensus price target of $275.25.
What I find most compelling, honestly, is the recent Goldman Sachs note.
Oh yeah, they just updated their thesis.
They reiterated a buy rating with a $285 target, but their underlying thesis is what really matters here. They are currently modeling 2027 earnings 34% ahead of the broader street consensus.
34% is a massive divergence.
It is. They are arguing that there is massive unseen earnings power. that the broader market simply hasn't priced in yet. And that's driven primarily by that RTX Spark PC expansion we talked about and the Vera Rubin data center ramp.
You also have an incredibly stable shareholder base to consider.
Right, the institutional ownership.
Yeah, it sits at 65%.
Yeah.
And it's heavily anchored by passive giants like Vanguard and BlackRock.
Which is important.
Super important.
Yeah.
Because when institutions hold that much of the float, it creates a buffer against wild retail swings.
As an investor, you have to filter out the speculative noise, too.
There is a lot of noise.
Right now, there are massive rumors circulating about a $5 billion strategic investment into Intel to secure foundry exclusivity. There are also rumors that Microsoft might guarantee design wins for RTX Spark in the next generation of Surface devices. So you have to ask yourself, are these rumors artificially propping up the current sentiment, or are they early indicators of complete, inescapable ecosystem dominance?
Well, if they actually lock down Intel's foundry space, they solve their biggest bottleneck, which is supply constraint.
Now let's talk about the risks.
Because you cannot invest on bullish sentiment alone. You just can't.
No, you have to take all this enthusiasm and pressure test it against the absolute worst-case scenarios.
So the most immediate one is the geopolitical and regulatory escalation with China.
Right, the Senate hearing stuff.
Exactly. But analytically, you have to wonder if that risk is already fully priced into the stock.
Yeah.
I mean, management's Q2 guidance already baked in zero revenue from the Chinese data center market.
That's true.
They have effectively ripped the Band-Aid off. China is now a known, cleared risk rather than some hidden landmine waiting to explode.
Okay, fair point, but you can't ignore the broader macro environment. We are seeing persistent inflation and really strong jobs data, which means the Federal Reserve is delaying interest rate cuts.
The higher for longer narrative.
Exactly. And a higher for longer interest rate environment mathematically punishes high multiple growth stocks.
Right, because of the discount rate.
Yeah. When interest rates are high, the future cash flows of a growth company are literally worth less in today's dollars. That is a gravitational pull that affects the entire tech sector, no matter how good the company is.
It is a standard macro headwind, I'll give you that. But the data shows that artificial intelligence infrastructure spending is uniquely rate agnostic right now.
Rate agnostic.
Yeah, meaning they don't care what the rates are. For the hyperscalers, buying this compute power is an existential arms race.
They have to spend it.
They literally cannot afford to stop spending, even if their borrowing costs are slightly higher. Because falling behind in the AI race means losing their core business models entirely.
Okay, but here is the risk that truly demands your attention, because it looks at the actual plumbing of how these deals are structured.
Oh, you're talking about the Burry warning?
Yes. Michael Burry recently issued a severe warning regarding what he calls circular financing. He specifically pointed to the $5.4 billion XAI deal, and he called the structure a fugazi.
Let's break down exactly how this mechanism works, because it's complex, but it is so crucial.
It really comes down to how revenue is recognized versus where the actual financial risk lives.
Right.
So in these massive deals, they often use special purpose vehicles, or SPVs.
Okay.
The company books billions in revenue up front for selling the hardware. But simultaneously, they're investing their own equity back into the customer, like the $1.9 billion investment in that exact XAI deal.
Right.
So they are effectively shifting the credit risk off their main balance sheet.
So they are, in part, helping to fund the very customers that are buying their products.
Exactly. It's like, okay, it's like loaning your neighbor money so they can buy lemonade from your own lemonade stand.
Which makes your lemonade stand look incredibly profitable.
Right. Today, your sales numbers look absolutely phenomenal. You're breaking records. But if the neighborhood economy crashes and your neighbor goes bankrupt, you don't just lose a future customer, you lose the original loan you gave them to buy the lemonade in the first place.
Oh, I see.
If there is a sudden drop in AI utilization or an unexpected technological obsolescence shock, these leveraged, multi-layered financing structures could amplify losses at lightning speed. It's off-balance sheet risk masquerading as organic growth.
That is a highly analytical and honestly valid concern about the absolute quality of the revenue.
It's scary if you really dig into it.
It is. However, you have to weigh that against the visibility cycle.
Explain that.
So the term CapEx visibility cycle simply means we can look at the publicly stated, locked-in capital expenditure budgets of the hyperscalers.
Yeah.
And those stretch all the way out into 2027.
Okay.
When you look at those budgets, the demand proves to be overwhelmingly organic. Right now, the entire industry is fundamentally constrained by supply. They literally cannot make the chips fast enough to meet the orders.
So you're saying the demand is real, regardless of the financing tricks.
Yes, the structural demand for raw compute power exists completely independently of the complex financing vehicles used to procure it.
So with everything on the table, what's the final verdict?
Well, when you synthesize the historic fundamentals against the complex geopolitical and financing risks we just discussed, the overarching research points to a bullish score of 9 out of 10.
9 out of 10.
Yeah. The core investment thesis remains totally intact. The company is the irreplaceable architect of the space, heavily insulated by a full-stack moat that integrates CDA software, high-speed networking, and next-generation silicon.
And practically speaking, the long-term view suggests a multi-year investment horizon.
Definitely.
Because to truly capture the value of the 2027 CapEx visibility cycle and to watch the Vera Rubin production ramp translate into actual earnings, you are really looking at a 12 to 24-month window.
Minimum.
Right. If you believe their full-stack ecosystem is the foundational layer for the next decade of technology, then the short-term macro volatility like we saw on June 6th is just noise.
Just a blip.
But you must remain hyper-vigilant about the regulatory headlines and obviously how these massive deals are being financed behind the scenes.
It's an unprecedented moment in market history, and it really requires careful, continuous analysis.
If you want to build a cleaner stock research workflow, you can check out stockanalysis.com Pro through the link below in the description. Use code ITP for 10% off. Pro comes down to about $5.93 per month when billed annually after the discount, and Unlimited comes down to about $14.93 per month when billed annually after the discount. Remember, stockanalysis.com is a research tool, not financial advice. It does not guarantee investment results, and you should always do your own research before making any investment decision. This is an affiliate link, and we may earn a commission at no extra cost to you.
And if this episode helped you, please subscribe, like, and comment underneath. We'll see you in the next Smart Wealth with Joshua episode.